Continuing with topic 2 of paper 9, we're now going to look at option markets, paragraph 4.2. We're going to look at exchange traded options versus over-the-counter options. Now, exchange traded options are traded on the Stock Exchange of Hong Kong, and they are standardized contract specifications detailing the features of the option, expiry date, exercise date, quantity of underlying asset, etc. And in Hong Kong, we've got 6 main exchange traded option categories: stock options, the actual stocks themselves are the underlying, and then the index options, Hang Seng Index, etc. And they're listed there. We cover them in more detail in topics 3 and 5. And then we have over-the-counter options. Now, these are similar to exchange traded options, except they are tailor-made and they are not traded on an exchange. So they're quite different. The details, the strike price, expiry date, etc., are tailor-made between the two counterparties, as are payoff characteristics. And when you have both the details of the option and the payoff characteristics tailor-made, we refer to them as exotic options. Now, you won't be doing much on exotic options on the exam, except being aware of what the 7 categories are. Now, they could, as an absolute outside chance, examine you on the meaning of one of these exotic options, and you can read the detail, but I'd be aware of the 7 categories. I wouldn't go any further. And what are these categories of these over-the-counter tailor-made options that we refer to as exotic options? Binary options, barrier options, compound options, look-back options, chooser options, average rate or Asian options, and rainbow options. As I say, be aware of the categories. I wouldn't spend too much time on that. What I would spend time on is understanding the 4 main payoff diagrams. These are diagrams showing the profit and or loss of a stock option position. We'll be looking at long call, short call, long put, and short put. Now, in the 4 diagrams that follow, we're using the same inputs: option premium of $5 and a strike price of $50. So if we have a long call, we're buying a call, and remember that gives us the right to buy the underlying stock or the underlying instrument at the strike price. And in our case, strike price is 50. So if we have the right to buy at 50, we're only going to do that if the price is above 50 in the market. Therefore, where the market price is below 50, we will not exercise the option. It will expire worthless, and we will have incurred the $5 premium. Therefore, we'll be showing a loss of $5. Now, you will see that the horizontal line is below the x-axis. Whenever in a payoff diagram you see the horizontal line below the x-axis, you know that money is being paid. The person has gone long. When the horizontal line is on the left, it is a call. When it's on the right, as we will see, it is a put. Now, at what point do we break even? Well, we've paid out a premium of $5 in the long call. We will break even when we make a profit by exercising of 5. The 5 profit will cancel out the 5 premium, and we will break even, and you will see that the break even is at 55. That is to say that we exercise at 50, we buy the underlying stock at 50, and we can sell it in the market at 55. There's our profit of 5, and that eliminates the premium of 5, so overall we break even. Now, the mirror image of a long call payoff diagram is the short call payoff diagram, where the seller of the call option receives the premium. Now, as long as the call is not exercised, that is, the price remains at or below 50, the seller of the call option will pocket the premium. They have made a profit. But it's the other way around from the long call. As the price increases, then the buyer of the call will exercise and make a profit. And that means the seller, the short call, will make a loss. And that loss will accumulate. And once it gets to 5, well, that will that will eliminate the premium that's been received, and so we will break even at 55. Now, when the horizontal line in a payoff diagram is above the exercise, above the x-axis, then we know that that is a short position because it's reflecting the profit that is made by bringing in the premium. Now, if we look at the other type, that is the two put diagrams, the long put and the short put. Now, again, we're looking at a mirror image. With the long put, we have the right to sell the underlying asset, the stock, and we can sell at 50. Now, we're not going to sell at 50 if the price is above 50. And so the option expires worthless and we've paid out the premium. So we make a loss of 5. But as the price of the underlying stock falls, then it becomes more and more attractive. And once it falls below 50, it's worthwhile exercising. We sell at 50, we buy it below 50, we make a profit, and that will cover part of our premium until we get to 45. So if the price falls to 45, we sell at 50, buy at 45, make $5 profit. That covers the premium and you have a break even. Once again, once the price goes beyond the break even, the long position goes into a net profit. The short position below, which again is the mirror image, will go into a loss position. Now, one thing to be aware of is that with the call, the profit for the long call and the loss for the short call is unlimited because the price can go up and up and up. But the gain for a long put and the loss for a short put is limited, and it's limited because the price can only fall as far as 0. It cannot go any further. Now, please be aware of these diagrams for the exam. They can examine you on the actual diagrams, but they can also ask questions based on the inputs, on the exercise price, the market price, and how much you will make on exercise, or how much you will lose, or they can ask a question on break-even level. Now, these types of questions are not difficult if you understand the mechanics of those payoff diagrams. Let's move on and look at hedging example, and this will take us through a hedge using options. Now, the full hedging example will not appear in the exam, but parts of it could, and I'll highlight that as I go through it. Okay, so details for this hedging example. We're told in April XD1, fund manager holds broad portfolio of Hong Kong stocks weighted to match performance of the Hang Seng Index. So it's highly likely we're going to be looking at index options. Portfolio is currently valued at 800 million Hong Kong dollars. Now, the fund manager fears a fall in the value of Hong Kong stocks. Now, if you're fearing a fall and you're considering options, you should be thinking buy put options. That's what should come into your mind. And he or she fears the fall over the next 3 months and wishes to hedge against a fall in the Hang Seng Index. And we're told it's currently at 25,600 index points. The fund manager is not permitted to sell options for hedging. Fund managers can, but that's more complex, and we'll deal with that later. But generally, selling options is far riskier than buying options because you can be exposed to loss. Now, is it call or put? Well, I've already said it should be puts. You want to buy puts. Now, which month, which contract month are you going to choose? Well, you know that your exposure is for 3 months, and we're told that the available contracts are April, May, June, September, and December. We've been told that we are now in April XD1. 3 months, April, May, June. Then, given your concerns over the next 3 months, most appropriate month is June. Now, that could be a question on its own, just given the months, given the time frame, which one should you go for? Then we're asked what strike price. and we're told that the Hang Seng Index provides strike prices between 16,000 and 30,000 at 200-point intervals. Now, we're told the fund manager can only tolerate a small decline in portfolio's values, and the index is at 25,600. The manager decides on a strike price of 25,000. In other words, he or she is happy to take a 600 loss, but not beyond. They want to have the right to sell at 25,000. So how many options will be required? And this could be a separate question all on its own. Well, we divide the value of the portfolio by the value of the Hang Seng Index options contract. What is the value of a Hang Seng Index options contract? It is the index level multiplied by the multiplier for options, which is same as futures, 50 Hong Kong dollars. So 25,000 multiplied by 50 gives us 1.25 million. Therefore, number of contracts that are required, the 800 million exposure divided by the value of a contract, 1.25 million, 640 contracts required. How much premium will be payable? Again, this could be a separate question. Well, assuming that the puts with 25,000 strike price are traded at a premium of 150, there we are, there's the price. Total premium, 150 multiplied by the multiplier, multiplied by number of contracts, 4.8 million premium. So if we're looking at the payoff diagram, we see that we are going long put, we're buying puts, so you expect to see horizontal line below the x-axis. The strike price is 25,000. We are protecting ourselves from a fall, so the break even is at 24,850. That is where we make a profit of 150 by selling at 25,000 with the price at 24,850, and that would cover the premium we've paid. So break even of 24,850. Right, let's look at the results of the hedge. We're told we're at the day before the date of expiry of the June XD1 options. What that means is there's virtually no time value, so that the option will be valued at the intrinsic value. We're then told that the Hang Seng Index has fallen to 22,400, which means fund manager's portfolio is now worth 700 million. How did we get that? Well, it's just proportions. 22,400 divided by the 25,600, the starting point, multiplied by the 800 million. It gives us a loss of 100 million Hong Kong dollars. That's on the portfolio. Now let's consider the result of the hedge. The option now trades at a premium of 2,600. How do we get that? Well, it's the 25,000, the strike price minus the current value, which is the same as the index because there is no time value. And so the premium is traded, the option is trading at a premium of 2,600 just before expiry. Now we bought the put options. We can close out our position not by exercising, but by selling at 2,600. So we sell the options 2,600, resulting in a cash settlement of 83.2 million. Where did we get that? The 2,600 price, again multiplied by the multiplier of 50, multiplied by the number of contracts, 640. Again, all of these calculations could be separate questions in the exam. So we made a loss on the portfolio. What was our profit on the options trade? Well, it's the cash settlement minus the premium cost. Our cash settlement was 83.2 million. We've just calculated that, minus the premium 4.8 million, giving us a profit in the options trade of 78.4 million. Now you see that the loss of 100 million is not being covered by the profit on the options trade. And that is just a loss that the fund manager was willing to pay for given his or her view on the market direction. Last bullet point, if the Hang Seng Index had risen instead of fallen, the option would have expired worthless. We would not have exercised it. There would be no point. There was no value, zero intrinsic value. And the fund manager would incur the premium cost of 4.8 million. But we would like to think that 4.8 million premium would have been covered by the gains in the portfolio value because the prices would have risen. Okay, so that's a fairly complex hedging example using put options to protect a portfolio from a fall in prices. And that's allowed us to walk through a full example. You're not going to get a question on that, obviously, but separate elements of that example could come up as the subject of one or more questions.